All right, good morning and welcome back, ladies and gentlemen. This Finom group. My name is Seth Golden. I'll be your host for this week's video update. And what we'll be discussing here this week, or maybe what we'll be reviewing here this week is the 2 week plus rally from late April into the start of the Q2 calendar season. You've heard the saying, sell in May and go away. Not necessarily true, but as I often point out, Wall Street colloquialisms, they're often not true. So with this week's video, what I wanted to do was kind of review where we've come from and where some of the data suggest we might be going. But also wanted to highlight that or remind investors where we are in the cycle and what has transpired over this secular bull market cycle, especially since 2018. Over the last 5.5 years, we've had 3 bear markets. And so as you see before you here, the graphic indicates that's very rare. In fact, you typically have only 1 bear market every 4.1 years. So the fact that we've had 3 in the last 5.5 years is quite remarkable. If you're leaning into a bearish posture or a bearish thesis near term, you may be very far out on a limb like this bear, reaching for that honeypot, so to speak. So do keep in mind, that this cycle is quite unique. And to the extent that we may have, pulled a lot of bearish price action forward in the past 5.5 years, in my opinion, that lends itself positively going forward. All right, with that, you've also heard me often say, down is good, up is simply better. Since the consolidation phase started in April, almost right away as we ended the first quarter, the market found an interim bottom recently and is on a path to recovery that I believe will eventually lead to new all-time highs. For the sake of practicality and what's actionable for the investor trader, who cares? And again, here's why I say that. Down is good. Up is simply better. Now, the folks that don't manage cash wisely, I'm all in. No, I'm all out. This doesn't mean a whole lot to those people. The savvy investor and trader knows down is good. Up is simply better. But up can really only be better if you take advantage of down, i.e. cheaper prices. The 2 most hated times to buy the market in history are when it's going up and when it's going down. By default, the right time to buy is when you don't want to. Regardless of how good or bad breadth is, there's still only one way to get a return on capital, and that's to buy. But for those of you who also want the data and analysis, of course, let's move on. Coming into this year, many of you might recall that I was of the opinion it could be a choppy year, but this could also be one of those years lacking a full 10% textbook correction. And as I said earlier this year, I'm okay making that call. If it comes to fruition, good, fine, great. Reality is it doesn't mean a whole lot if you don't take advantage of these interim pullbacks, or if we do get a full-blown correction. Not really saying a lot by making this call, but there is a lot of data that I gathered coming into this year that I disseminated to Finom Group members coming into this year that supports this kind of an outlook. One of them, more recently, updated our Finom Group members, but coming into the year, we understood we had dueling Zwig breath thrust. In other words, and this was misspelled, by the way, the header, um, but only 2 times in the post-World War period did we have 2 Zwig breath thrusts in the same calendar year. Back in 1963, I'm sorry, 1962 leading into 1963, and last year, 2023. In 2023, we had a Zwig breath thrust in March, and for those of you not familiar with the Zwig breath thrust, I'll make it really simple for you. It tells you no matter what, whenever there is a dip after the Zwig breath thrust, you want to be a buyer of that dip. 6 months forward after a Zwig breath thrust and 12 months forward, the market has never delivered a negative return. Never. So in 2023, we had a March Zwig breath thrust. And then in November 2nd, we had the second Zwig breath thrust of the year. In 1962, we had 2 almost simultaneous Zwig breath thrusts that led to the 1963 through 1964 rally. Wouldn't you know it? It kind of started out the same way. The Zwig breath thrust led to more and more gains. Eventually, we hit 5,000 in 2024, and ultimately 5250 as a closing high for round number's sake. I've been using this 1962 double Zwig breath thrust analog ever since we completed our second Zwig breath thrust, and so far so good. But more importantly, when we look at 1963 after the dueling Zwig breath thrust of 1962, I studied what was the biggest pullbacks in 1963. Wouldn't you know it? 5%. Now, we just went through a 5% pullback here in the S&P 500. Does this mean that because we're using this analog, we should only expect a 5% pullback in 2024? Yes and no. Analogs are used for a reason, right? But keep in mind, they're more of a path, a guide, if you will. They're a guide. You might anticipate just a 5% pullback here this year, but how many, right? And again, there's no guarantees here, but so far the similarities in price action from 1963 and here in 2024, they're undeniable. They are undeniable at this stage of the bull market. With that being said, as I mentioned before, 6 months after a Zwig breath thrust, there's no negative returns here. 12 months after a Zwig breath thrust, no negative returns here. Hence, you get a dip, buy it. Could this be the first time in history that we do get a negative return? 12 months later, keeping in mind that we're already 6 months past the Zwig breath thrust from November 3rd of 2023. And we do have a positive return. So could this be the first time in history we get a negative return 12 months later? It absolutely could. Is that really the probability you want to lean into? Remember, investing is about probability, stacking the deck in your favor. Do you think leaning into the first time ever, 12 months post a Zwig breath thrust, do you think leaning into a negative outcome is the wise choice? That's the question you ask yourself. You lean into the higher probability outcomes as a savvy investor. One of the other reasons, and again, that was it. 5% pullback was the biggest pullback in 1963 after the dueling Zwig breath thrust. So going back to my call so far as I don't believe we're going to get a 10% full correction here in 2024. This was one way of recognizing that probability, not guarantee, but probability. Another study that we looked at from the sentiment trader was, the S&P 500 after a VIX jumps 40 or greater than 40% in 10 days, but the VIX level is still under 20. And by the way, this has happened now twice this calendar year. more recently here, just a week ago or so. But when we looked at this from earlier this year, we understood that these kind of freakouts, as Sentiment Trader calls it, freakouts, are a hallmark of markets, especially bull markets. Out of the 17 times the VIX jumped from the ultra calm conditions, only one of those occasions led to more than a 10% loss within the next 3 months. And that was right here in 2020. We all know 2020, COVID, right? So there's an exception to the rule. That was an exogenous event. Hey, I can't predict exogenous events, black swan events. That's not your job as an investor. They happen. They're called black swans because they come out of the blue. You're not supposed to be able to predict them. They happen. But again, only one of these quote unquote VIX freakouts led to a 10% or greater correction in the coming 3-month period. It's a very low probability that we're going to have a full 10% correction since the VIX freakout, which, and I basically told you what to do. If you follow me on social media, I told you what to do. April 17th, my favorite market signal. Again, this is when the VIX jumps 40% or greater. 10 to 12 days, the rate of change was 41.43%, getting above this threshold line. It's the only guaranteed trade, short volatility. Only guaranteed profit in the market should one commence shorting volatility. By the way, if you shorted, let's say instruments like VXX, UVXY, on this day, since then, since April 17th, the VIX has gone from 20 back down below 14. VXX and UVXY have hit new all-time closing lows. The S&P 500 has rallied from the 4,900s to 5,200 as of yesterday. Only guaranteed profit. I'm guiding you, folks. Come on, work with me. Work with me. Anyways, point being that these are two examples of why I was not of the opinion, and still not of the opinion, we're going to get a full 10% correction. I'm open to be proven wrong. It happens. Nobody's perfect. I'm not giving you a guarantee on that. I'll give you a guarantee on the short volatility trade, though. All right, with that being said, moving on. Several weeks back, I believe this is from getting a peek inside of our April. After that monthly options expiration week, we had oversold conditions. We were actually going into monthly options expiration with oversold conditions. Oversold, this is the McClellan oscillator. We talked about it getting below -80. And that's where you want to start buying. Focus on the word start. Don't buy all at once. Oversold conditions can last longer than you think. And sometimes they need compounding oversold conditions. This was one oversold condition by way of the S&P 500's McClellan oscillator getting into the buy zone. This was another one, the S&P 500 10-day advanced decline line, falling off a cliff, getting into the oversold savvy bull buy zone. Now, back in mid-April, going through that monthly options expiration, we also highlighted this quantitative study from quant of all quants, Wayne Whaley, which had a perfect track record, 14-0. If you were up in the first quarter, the market was up in the first quarter, April 11th, I'm sorry, so you were up in the first quarter, but then from the end of the first quarter, March 31st, through April 11th, the market was negative. The period from the 11th through the 20th was positive every single time. Folks, this data goes back all the way to 1976. It's happened 14 times before these conditions, and the market has delivered a positive return every single time until 2024. Hence, there's a first time for everything. So indeed, we have to, be open-minded. There could be a first time for everything when it comes to the Zwig breadth thrust and forward 12-month returns. I'm not betting that way, and I wasn't betting this way on this studying either. I was buying. We had oversold conditions. I was buying. If this study didn't pan out, good, fine, great. There's nothing I can do about it other than hold longer, understanding that we're only going to remain oversold for so long, especially in a bull market, especially in a economic expansion cycle, and especially as earnings are coming in better than expected. Much better than expected, if I should emphasize anything. So that sucks, right? Wayne Whaley, this study didn't come to fruition what's that going to be? 14-1. Does that mean you give up on all quantitative analysis, by the way, because this study finally delivered a negative return? No. You don't give up on quantitative analysis because one study failed to achieve the greatest probable outcome and is no longer perfect. More. The following week, we had more oversold conditions. The NYSE dropped to -100. The NYSE McClellan oscillator, -100. Deeply oversold. Each time it got into these deeply oversold, if you were buying, good stuff happened in the S&P 500. If you were buying, good stuff happened in the S&P 500. Buying, good stuff happens. Buying initially, but we did find a lower point here. And again, good stuff happens. Be a savvy bull. Don't worry about, am I picking the exact bottom? Your chances of picking the exact bottom are limited. Focus on buying value. Focus on buying oversold conditions in a bull market will eventually revert to the upside. All right, and that's exactly what we did. Again, most of these notes, you look at the date, 15th, April 15th. You look at this date, April 12th. The market is higher than when both of these oversold conditions were revealed. The market is higher than April 11th through the 20th as well, even though it wasn't higher during the 11th through 20th period. I know a lot of folks are still concerned about the inflation picture, right? We had a first quarter whereby the disinflation phase kind of petered out or had a temporary trough or pause, as I would call it. And all we ever hear about is this going to be like the 1970s or early 1980s where we had stop-start inflation. It's funny how you'll never hear it in the financial media. You never talk about the 1943 through 1949 inflation post World War II episode. Up in the top chart here, 1943 to 1949 CPI percent on the year. We had this massive spike coming out of World War II. 1946, massive spike in CPI up to nearly 20%. By early 1947, inflation rolled over into early 1948, and kind of in the same situation in the first quarter. It troughed and started a little bit of an uptick before ultimately reverting massively to the downside. Wouldn't you know it? Massive spike here in 2022, got to just over 9% CPI, rolled over, might have hit a trough here, and has been slightly ticking up here in Q1 of 2024. But again, we never hear about the post-World War II spike in inflation where it had its pause period, but did prove to disinflate thereafter. One of the things you're going to have to see, and I know all the talk about supercore and services inflation, gets all the attention because that's where the negative disinflationary outcomes are being seen, meaning not as disinflationary in services, and supercore, which deals more with rent and shelter inflation, right? That gets all the headlines. But what you don't hear is this simple fact. If you don't have commodity prices reflating in a significant manner, you're going to have more disinflation. It's inevitable. There's never been, since the 1970s, there's never been an inflation spike without commodity prices spiking. Do keep that in mind. Last chart here from Renaissance Macro's chief economist and market strategist, Neil Dutta. And what this chart, this is like a clock, okay? We started here in this quadrant, if you will, the lower left. And for one reason or another, i.e. inflation is your y-axis here, your x-axis is the S&P 500 returns. But for one reason or another, we had a bit of an uptick in inflation. Again, going up, this shows the inflation, or coming down. We ticked up to this quadrant, a little bit more inflation, a little bit lesser returns for the S&P 500. This is an unusual path. This is going clockwise. Usually, we go counterclockwise as indicated by the red arrow, right? You get a pretty robust move in inflation to the upside, spike in inflation where the worst of S&P 500 returns are, hence the red quadrants. But this time we kind of had this kind of move here, slight uptick in the inflation data. It's not the worst of S&P 500 returns, but it certainly isn't the best. What Neil Dutta believes is that just like the 1943 through 1949 episode of inflation, we're going to rotate back down and get back into the best returns for the S&P 500, get back to that disinflationary cycle. As I mentioned before, where one study fails, Wayne Whaley's quant that we just reviewed, where that fails, others remain perfect. And this is what we've talked about with our Finom group members. Look, if you're not subscribed, you're not getting this research each and every week. You may not have the best guide to what you should be anticipating and therefore reacting to with your capital in the markets to deliver those better returns. Subscribe to Finom Group's macro market research report. It's only $18.99 a month. It'll get you done. It's kind of like if you shorted volatility, you get a guaranteed profit. This is the kind of stuff that we are delivering to our Finom Group members every single week. So this study here was a study that discussed the S&P 500's relative strength index, which was above 50 for 80 plus consecutive days. It was actually above 50 for almost 100 days. And what we understood is that when you have this kind of streak of relative strength in the S&P 500, 2 months later, 3 months later, 6, 12 months later, the market is higher every single occurrence. Again, this data goes all the way back to the 1920s, folks. Sentiment trader study. I wanted to look deeper because the streak did end, right? In April, it ended as we went through this consolidation phase. And what I found is that after it ended, the closing price of the S&P 500 on the day this streak ended of greater than 50 RSI days for the S&P, the market closed at 51.47. Remember, 2 months later, 3 months later, 6 months later, positive every single time. In fact, 21 days later, as these two studies show, 21 days past the breaking of the streak, just the streak breaking, 21 days later and 63 days. Why 21 days? That's about a calendar month of trading. 63 is three calendar months. But in the two studies above, this one and this one, 21 days and 61 days, we also showed after the initial break of the streak, 21 days later, 100% positivity rate. 63 days later, 100% positivity rate. Hence that 5147 being critical, because a month later, this happened on April 4th, was the break. And the closing price was 5147, which told us by 21 days later or a calendar month later, so May 4th, or the first day after, if that falls on a weekend, which it did, so May 5th, the S&P 500, if this is going to remain perfect at 100%, we have to close above 5147 on May 5th, the first calendar day after that weekend. And wouldn't you know it, we did. We absolutely did. And here's that study in our macro research report from April 21st. We knew what to expect. We knew what to anticipate. And therefore, when the markets were still swooning and everybody was wondering, is this going to be a full 10% correction? We were buying. We encouraged buying the dip. How often the S&P 500 has peaked for the year each month since 1980? Was the peak in March? Was that the high for the year? Probably not based on this data. Only one other time did the market make a new all-time high in the month of March since 1980. It's 43 years of data, folks. Only once. More often than not, the S&P makes its top in either January or during the fourth quarter, October, November, December. So if you thought that March was going to be the high for the year, you are leaning into the lowest probability. Only 2% of tops for the year have been made in the month of March since 1980. Again, all this data is great. Tells you to buy the dip. Tells you to buy the dip. Because more than likely by the end of the year, there will be a new all-time high. Naturally, I'm talking about index ETFs here, folks. You buy the dip in individual stocks, they may not come back. Not all stocks do. Finom Group's S&P 500 upwardly revised 2024 target objective. So coming into this year, we believed in the first half of the year, the S&P 500 would hit 5,200. That's right, the first half of the year. Right? While other strategists and big Wall Street firms were claiming 5,200 for the year, we were very specific. We thought it could hit that by the first half of the year. Lo and behold, it has, which forces us into a position where we update our price target objective. Assuming no recession through year-end 2024 and full-year EPS of 250 a share, we target S&P 500 to achieve 5,400 by year-end. Last bullet point, assuming no recession through Q1 2025, our S&P 500 profit objective, that's 12 months, a 12-month profit objective, price target objective. Through Q1 and 2024 to Q1 end 2025 is set at 5,500. Could this be low? Yes, it could be high as well. You never know. We give all of our rationale, and this is not all encompassing, but this is part of our rationale as to why we believe 5,400 by year end can and should be achieved. With that being said, again, thank you for joining me this week on our weekly video. Hold on 1 second. If you're not a member, Finom Group, as always, if you're not getting our weekly guidance, all of our analytics, all of our research and analysis, you know what to do. Have a great week, everybody. Trade safely. See you back here next time.